From the library of the New York Stock Exchange at the corner of Wall and Broad Streets in New York City, you're inside the Ice House, our podcast from Intercontinental Exchange on markets, leadership, and vision in global business. The dream drivers that have made the NYSE an indispensable institution of global growth for over 225 years. Each week, we feature stories of those who hatch plans, create jobs, and harness the engine of capitalism. Right here, right now at the NYSE and at ICE's exchanges and clearinghouses around the world. And now welcome inside the Ice House. Here's your host, Josh King of Intercontinental Exchange.
When I last filled up the Chevy Colorado down at Hickory Hill Market, the price of a gallon of gas was $1.99. And I know that's well above the national average of $1.77, according to AAA. Now, from that endpoint, the price we pay at the pump, all the way upstream to where domestic crude oil is delivered in Cushing, Oklahoma, we have a little problem. And it centers around that small town. A Financial Times story began last week, and I'm going to quote, Cushing, Oklahoma, population 7,800, has a steakhouse, a burrito restaurant, and a KFC. It also has America's most important complex of oil storage tanks, unquote. So those oil storage tanks, they're just about full to the brim. There's nowhere else to put the stuff. Why? Ask Adam Smith. Back in 1776, when he published The Wealth of Nations, the book so many of us read back in college, are the smart kids who read it in high school, Smith wrote in Book 1, Chapter 7, of the natural and market price for commodities. He wrote, when the quantity brought to market exceeds the effectual demand, it cannot all be sold to those who are willing to pay the whole value of the rent, wages, and profit, which must be paid in order to bring it thither. Some part must be sold to those who are willing to pay less, and the low price which they give for it must reduce the price of the whole. The market price will sink more or less below the natural price. According to the greatness of the excess increases, more or less the competition of the sellers, or according as it happens to be more or less important to them to get immediately rid of the commodity. That Adam Smith from The Wealth of Nations. So, in other words, when a coronavirus stops a country almost dead in its tracks, and there's no demand to fuel cars to drive, planes to fly, or ships to navigate the oceans, demand dries up. But in the case of crude oil, it takes a lot more to stop supply. From shuttering wells in the Permian Basin to agreement among nations like Saudi Arabia and Russia to cap production. No easy trick, that. Intercontinental Exchange's president, Ben Jackson, put it another way in the company's first quarter earnings conference call, which took place last Thursday, when he told analysts, distinguishing the differences between the landlocked WTI futures contract and the seaborne ICE Brent futures contract, and I'm quoting Ben here, there's well-publicized structural issues at Cushing. Infrastructure issues have happened in the past with pipeline and storage issues that create volatility in delivery. The major difference between that and Brent is a waterborne contract where it is much easier to load crude on the vessel and bring it anywhere in the world where there's demand and the economics make sense. You'll see the huge demand pool that you're servicing with the Brent contract, and you don't have those fundamental landlocked structural constraints on the contracts. That from ICE's president, Ben Jackson, which brings us to this week's episode. You know that over the last few weeks, we've occasionally been bringing you inside some of ICE's special series of webcasts that it produces for its customers and partners on key issues facing those who trade in the markets during these unprecedented weeks when so much of the world is sheltering in place. Issues having to do with containing, curing, and vaccinating against the coronavirus, to issues facing the broader economy. Last week, you heard Jim Greenwood, the president and CEO of the Biotechnology Innovation Organization, or BIO. And this week, it's Daniel Yergin, who the New York Times called the king of the oil pundits. What you'll hear in this episode is a conversation between ICE's head of global sales, Jeff Barbuto, and Dan Yergin. Dan is vice chairman of IHS Markit and the Pulitzer Prize-winning author of The Prize, The Epic Quest for Oil, Money, and Power. and also The Quest, Energy, Security, and the Remaking of the Modern World. Coming out in September, Dan has a new book, The New Map, Energy, Climate, and the Clash of Nations. In his conversation, Dan gave the audience an exclusive preview and his take on the volatility we're seeing every day. Later in the conversation, I come back and moderate a series of questions that came into us from live listeners of the webcast, and Dan's thoughts on their comments were fascinating. You should also know a little bit about our discussion leader, Jeff Barbuto, who manages ICE's global oil business, our oil market development, and the oil sales team. Jeff started his career back in 1997 as a broker of fuel oil swaps, options, and physical barges, back when oil derivatives were traded solely over the phone. He joined ICE in 2001, working with Jeff Sprecher and ICE's founders to develop the oil derivatives business on the ICE platform, managing, among other things, the transition of the Brent crude oil contract that Ben Jackson was talking about on our earnings call, way back when crude was bought and sold from the trading pits on the floor of the old International Petroleum Exchange, to now when it's a fully electronic market on ICE, a transition that has grown volumes more than tenfold since then. So with that, after this, the next voice you'll hear will be Jeff Barbuto in conversation with Dan Yergin. That's right, after this.
And now a word from John Berger, President and CEO of Sunnova, NYSE ticker NOVA.
We're a solar company, and we're out there to bring solar to every home in the country. We have such a vast market that remains untapped. I think it's less than 3% of the market of homes in the United States, and so there's just so much potential. New York Stock Exchange is the home of capitalism. It's just where the action happens. No matter where you are in the world, all eyes are on the New York Stock Exchange. Sunnova, now listed on the New York Stock Exchange.
Thanks, Josh. Dan, thanks for being with us. There's been so much going on in the oil market these past couple of weeks. It's just a great time to have you here and get some perspective from you. I wanted to start out with the oil price war between Russia and the Saudis. At the end of last year, U.S. shale oil accounted for 15% of global oil production, whereas Saudi and Russia remained at 12 and 13%. I want to get your thoughts on to what extent you think this was aimed at crushing U.S. production specifically.
Thank you, Jeff. I'm very glad to be on, and hello to everybody to join this conversation. Josh, thank you for that nice introduction, and thank you for the pre-order of the new book. I think you put your finger on, Jeff, what certainly was part of it. In Russia, there was a real division between those who said we should cooperate with OPEC Plus and OPEC agreement, and those who said, why are we doing this? We're giving up market share to the United States. Some saw shale as really an adjunct to U.S. foreign policy, enabling the U.S. to use sanctions on Russian trading companies, and most notably on the Nord Stream pipeline. So that was part of it, and it was divided there. I think the Saudis were in general saying, why should we make room for other people and make all the cuts? So I think shale was part of it. I think there was also that definite sense of competition with Russia. And you just have to keep in mind what a dynamic new force U.S. shale was. When they put in that original OPEC Plus agreement in 2016, at that point, since the 4 years it was in place, U.S. oil production went up 60%. And in February of this year, ironically, U.S. oil production reached its high point of 13.1 million barrels a day, way ahead of Russia and Saudi Arabia. So I think for both those countries, shale was a part of the picture, and it was generally the sense what Ali Naimi, the former Saudi oil minister, said, all the new players in the world oil market, and shale was at the top of the list.
So can you give us some historical perspective on what we're seeing now in terms of a massive supply shock and demand shock at the same time, and how that compares with past challenges to the U.S. oil industry?
You know, Jeff, sometimes I think that one of the adjectives that has become part of our vocabulary is unprecedented. And so this is unprecedented. There are analogies in 1986, 1998, during basically market share wars, ran out of space and out of storage, and prices went down to $10 a barrel. But in some ways, the only, an analogy, you have to go back 90 years, really, to the great flood of oil in West Texas in the early 1930s when the price of oil went to 10 cents a barrel, which would be a little over $1 today if you correct for inflation. That's when the system of pro-rationing by the Texas Railroad Commission, that is managing production by the state, came in to deal with that flood of oil. But there's never been a time, even during the Depression, demand went down, but you've never had what we're seeing today. This month, we think demand could be down as much as 30 million barrels a day. That's almost a third of total world demand.
Yeah, it's pretty incredible. So one of the other things we've been watching is the storage capacity quickly filling up globally. And then on Monday, we saw the May WTI contract trade down to minus $37, which is pretty incredible. What's the significance to you of the recent cooperation between Saudis, Russia, and the U.S. as part of that OPEC deal? And do you think it did enough to at least get us on the road towards balancing?
So, Jeff, there's two parts to the question. Let's do the deal first. I think, when Saudi and Russia broke up at the beginning of March, it looked like, we're going to have a war for market share. I think that was happening. We were moving from the first phase of the corona crisis, and people didn't really visualize. It was hard to visualize the second phase where everybody's at home. And I think it was sort of backward-looking to the decline of demand of 6 million barrels a day, which is what you had in the first quarter because of the shutdown of China. As the weeks went on, it became clear that obviously we were in a second phase where a lot more demand was disappearing. And I think that what brought them together was partly Donald Trump. He had negotiated against OPEC with tweets, but I think, and as he said, he was always in favor of low gasoline prices, particularly in an election year. But I think what turned him around was, one, U.S. losing, quote, what they call energy dominance in the administration. Secondly, it was the economic impact, not only in the oil states, but in the industrial states of the Midwest, which are very connected. And I think there was a national security that, like energy independence, and there was a political view as well that Texas has almost twice as many electoral votes as Pennsylvania and Illinois combined, so very significant state. So I think that got him mobilized, and if he was a deal maker, this was his mega deal. I think the Saudis and the Russians were brought to the table by partly U.S. arm twisting. The U.S. senators from the oil states became part of the equation. And I think also they realized they were running into the problem they couldn't sell their oil. And you talked about storage. Russia doesn't have a lot of storage. So I think all those things came together to come, again, to use that adjective, this unprecedented agreement to cut back, which was put in place just about 2 weeks ago.
Starting here, do you think that was a one-off cooperation between Trump and the Saudis and Russians, or do you think we're going to continue to see that, and especially as it looks like we may need deeper cuts
I think
to catch up with reality?
I think President Trump is going to continue to be engaged in this, and there is talk of deeper cuts, but there'll be political decisions which will affect production, and then there'll just be the reality of lower investment, almost a freezing up in the United States. Short cycle oil, shale oil requires constant drilling to replenish and grow, and you can see activity going to a much lower level, and some companies just not drilling at all. Just what's the point at this price level? Or they can't because they don't have the funds. And then the other part of it is going to be the shutdowns, and we've seen shutdowns in the U.S. I think with the international companies, it's more complicated outside the United States to shut down because of agreements with governments and so forth, and which fields you shut down and what are the costs of. But so what we see when we talk to industry participants, they're going through a difficult internal process of assessing where to shut down and how much. So I think that's going to be part of the adjustment too. We think in the U.S. we'll see between 1.75 and 2 million barrels a day of shutdowns in the next couple of months. So that will be part of the balancing. Canada will be another place. Then it's going to happen elsewhere in the world, and I think some of the big producers, like Kuwait, has announced that it's going to start, not wait till May 1st, it's going to start pulling down its production now.
So it kind of leads nicely into the sort of New World Order and the subject of your book, it'd be fresh in your mind. I guess, the New World Order in terms of alliances between producing nations and consuming nations. And I wondered how much do you think we've seen that change happen for good?
Well, I wouldn't say for good, because things change. Politics will change. We have an election coming in November, and the Democrats have different attitudes. Some of the Democrats for the energy business and the Republicans. But I think it does reflect a reality, and the reality is that the kind of old world of OPEC, non-OPEC, has really become a world dominated by the big three. It's Saudi Arabia, Russia, and the United States. And what each of those countries do and how they interact will do much to shape the oil market in the future when this crisis is over.
One of the aspects of this that's been interesting to me is the market's been focused on all the turmoil we've been discussing for the last several months, and we've sort of forgotten, or it's fallen out of the headlines, is phase one of the trade deal between the U.S. and China. And one of the biggest headline commitments was that China was supposed to buy $18.5 billion worth of energy in 2020 alone. I'm curious what you think of how that all looks now, and how do you think that plays out, especially going into the election year? Yeah.
Well, of course, for U.S. producers and for U.S. LNG, the China market is very important, but the China market shut down. I think that if we remember the kind of depressive impacts on the oil market late last year was trade war with the U.S. and China, and it kind of looked, well, that got resolved and the markets were looking better and so forth. We did think the numbers that were promised were very high in terms of actually how much that China could absorb from the United States. But I think from the beginning of this administration, they looked to LNG, for instance, as a very important way of helping to balance out the trading relationship. But there is, I think there's concern about where the U.S.-China relationship goes after this crisis, because there are issues that I talk about in my new book about the South China Sea and so forth. But also I think there's going to be a question of where did this virus come from, and that's going to be very controversial. And you can feel that the divergence between China and the United States is kind of going to be a feature of the world after this crisis is over.
Right, and I'm sure it's going to be a big part of the debate during the election period. Dan, at this point, I'm going to pass it over to Josh to see if we have some questions from the audience.
Yeah, thanks, Jeff. We got scores of questions coming in. I'm just going to throw some of them at Dan, and Jeff, if there's anything you might want to add to these, please do. Will prices rebound fast enough to save many U.S. fracking oil companies?
I think that some of the companies are going to be under, some of the companies will disappear. The oil won't disappear, but I think it's going to be very hard. The mainstream program will help, and Secretary of Energy Dan Brouillette is working on a program to create a lending facility for the major E&P companies, the independents, so that they can have access to liquidity too. So I think liquidity is going to be a big problem. And I think, the U.S. will still be a big producer, but our production will go down. And it's a really tough time for a lot of the companies and the people who work in the industry.
Will we see greater consolidation in the U.S. oil industry as a result of the situation?
I would think so, that we will see in one form or another. I mean, there will be the question of people assuming other people's debt levels, but I think inevitably there'll be restructuring that will come out of this. One of the features of the last couple of years was a big commitment of the largest majors to participating in shale, and I think that will continue. But I think consolidation's coming.
Does Daniel agree that the Saudi response to flood the market was immature and not properly considered? MBS seems to have shown his inexperience as a leader here, and it's actually also hurt the Saudis.
Well, that's I think I hear the answer in the question. I think it was, I know what the Saudi rationale was and the Russian rationale was. I think it was I think it was based upon looking backwards at the market, not looking forward what was going to happen in the market. And what did happen is that it did create which I mentioned before, a real political reaction in the United States, where some of the senators were, from oil-producing states who vote in favor of military relationship with Saudi Arabia, were saying Saudi Arabia was waging economic warfare on the United States. And I think that was one of the things that led to the reversal of the opinion.
During a downturn, there are always opportunities. Where do you think the opportunities will be in the energy market during this pandemic?
Well, I think those who have capital and access to capital will be able that there will be opportunities there in the low prices and in the low price of assets, because it's hard. It may not seem that way right now, but this will end. It's probably not going to end with a V-shaped recovery. Our economists think it's going to be very U-shaped, but values will be greater in the future. So it's those who have capital who will be able to benefit from the opportunities. I think that we'll see more divestments by international companies, which will create opportunities for people. And then I think the domestic industry is really going to need capital.
Absent the pandemic, what did the aggregate production curve look like for U.S. shale? When was peak U.S. shale oil likely to occur, in your opinion, and how has the combined effect of the pandemic and OPEC's shift to a market share strategy impacted the shape of that curve?
Well, we were thinking at the beginning of the year, our team that focuses on shale, that we were not going to see any more 1.5 million, 2 million barrels a day. We thought maybe in 2021, with the economic forecast at the beginning of the year, that it would be about a 400,000 barrel a day addition, and we saw it flattening out in the sort of 13 to 14 million barrel a day range, partly because of the change in the relationship between companies and investors and the focus of return of capital to investors, and that the companies were going to live within their cash flow and give money back, and so that was going to slow activity down anyway. So that 13, 14, we thought that was the U.S. could be on that kind of plateau for a few years. I think that we think now at the end of this year, U.S. production, think 13.1 at the beginning of the year, probably be around 10 million barrels a day, and it could go another 1 million barrels a day lower in the next year. So the U.S. is still going to be one of the big three, but not quite with all the muscle that it seemed to have in February.
If there is a bigger than anticipated shift back to business as usual before the end of the year and energy demand improves significantly, what remains as some of the longer-term irreversible casualties of COVID-19 related crash in demand and prices?
Well, I think one thing is distributed work. I mean, the rise of Zoom, the fact that and that will have an impact, I think, on business travel. We saw our economists, went back and looked after 9/11. It took 2.5 years for air travel in the U.S. to return to the level it had been before 9/11. And I think there'll be people will tend to want to drive, not fly. I think that will be a consequence. So we're not expecting, and it will be very tied to GDP as well. So we would expect that, probably the world doesn't return to 100 million barrels a day anytime soon. There'll be a couple of years, certainly, to do that. So the shape of, and companies, everybody's struggling with this question, how will the demand curve be shaped by what's happened? And, behavior will, a lot of it will have to do with human behavior. It is interesting. Parts of the economy, we do a CERAWeek conversation. I did one with the CEO of Dow, and he said Dow's factories are operating at 80%. So, parts of the economy definitely continue to work, but it's so much of the service part of our economy is what's shut down.
Where does this leave other oil-producing countries such as Canada?
Well, Canada went into this with a problem, which is access to the United States pipelines, the ability to get its oil out. And it was very noteworthy that the province of Alberta stepped in to be a partner in Keystone XL and to finance it, and saying it is really economically essential. I mean, we think Canada will probably have cutbacks as much as 1 million barrels a day. So obviously for the Canadian industry, and prices very low, not full access to markets, big problem. I was just looking at a new report we've done on the OPEC countries, and it's quite dramatic to see what's going to happen to government revenues in countries like Nigeria, Libya, Angola, Iraq. So I think one thing you should expect is there's going to be real turbulence in those countries. They're not going to be able to pay civil servants. They're only able to pay half their civil servants in Iraq now. So I think there's going to be political turmoil, social turmoil in those countries that are so dependent on oil revenue and really have not been able to shift. I mean, oil is 75% of Nigeria's budget.
How much do you think the oil glut and low oil prices will play as an agent toward a faster recovery post-coronavirus, be that through lower travel costs or increased profitability in oil-hungry manufacturing processes?
Well, that's a very interesting question, because coming out of this, we're going to have high inventories. The inventory level will probably be 3 times what it was in 2014, 2015. And one of the noteworthy things in the agreement that was made among 2 weeks ago was that it provided that there would be a descending series of cuts, but to maintain them for 2 years to work off the inventory glut. And I thought that was kind of, noteworthy to see the need to do that. That sort of would get us back, that question gets us back to the more traditional way where low oil prices are a stimulus to the economic growth. I think that's a factor to think about. Let us take that under consideration. It'd be back more to a traditional model like 1998 or after 1986.
I got a question that just came in from a guy named Jeff Sprecher. We know him. He says, "What does this low
knows all
oil?"
The answers.
Well, he wants to hear from you, Dan. So I'm going to put Jeff's question to you. He says, "What does this low oil price environment mean for Iranian revenues and the stability of its current regime?"
Well, the interesting thing about Iran is that, of course, it has, it's been sanctioned, so it's only able to sell a few 100,000 barrels a day anyway. So in a sense, it's already made the adjustment, and it's a more diversified economy. Iran is the 6th or 7th largest automobile manufacturer in the world. So I think they're already living their kind of wartime economy. I mean, it's an economy that's under a lot of pressure, and they're holding it together. Obviously one has to be continued concerned about what kind of clashes or accidents could happen in the near term, as we've seen in the last couple of days with Iranian boats in the Persian Gulf. So although, traditionally oil has been 50% roughly of the revenues of the government, they've been sort of living without it. They've already been on an enforced diet.
Based on the pace of the inbound questions, we could certainly keep this going for another half hour at least, Dan. But I'm going to ask one more question. Will institutional capital come back to the shale industry after poor returns that were there even before COVID?
Well, that picks up on what the point I said before, which is that there had been kind of a divorce between the capital markets and institutional markets and shale. And I think that the shale companies were needing to build credibility that they could return capital, stay within their cash flows, and manage differently. And I think that was in process. You saw a number of companies, like Pioneer and many others, all basically moving in that direction, even dividends and so forth. It was like there needed to be a new social contract or compact between institutional investors and the shale companies, and that would have taken 4 or 5 quarters, I think, to demonstrate it. But I think the progress towards that has been disrupted by this, this calamity that has hit the oil industry, but it really has hit the entire economy.
Jeff Barbuto, let me pass it back to you for any final thought or question for Dan.
Great. Thanks, Josh. Dan, I just want to thank you so much for participating today, and hopefully we can have you back as as this unfolds further.
I'd be happy to do it. Great questions. I know we only got through some of them, but a lot of questions to think upon. So thank you all for the questions and for the opportunity to be part of this dialogue.
So thanks to Dan Yergin and Jeff Barbuto for their time and insight. And that's our conversation for this week. Our guests were Dan Yergin, Vice Chairman of IHS Markit, and Jeff Barbuto, Intercontinental Exchange's Head of Oil Sales. If you like what you heard, please rate us on iTunes so other folks know where to find us. And if you've got a question or a comment you'd like one of our experts to tackle on a future show, email us at icehouse@theice.com or tweet at us at icehousepodcast. Our show is produced by Pete Ash with production assistance from Ken Abel and Ian Wolfe. I'm Josh King, your host, signing off from the remote library of the New York Stock Exchange here in the Catskills. Thanks for listening. Stay safe, and we'll talk to you next week.
Information contained in this podcast was obtained in part from publicly available sources and not independently verified. Neither ICE nor its affiliates make any representations or warranties, express or implied, as to the accuracy or completeness of the information and do not sponsor, approve, or endorse any of the content herein, all of which is presented solely for informational and educational purposes. Nothing herein constitutes an offer to sell, a solicitation of an offer to buy any security, or a recommendation of any security or trading practice. Some portions of the preceding conversation may have been edited for the purpose of length or clarity.